Hello, and welcome to the 7th webinar in our series based on the new Oxford University Press book, Putting Purpose into Practice. Last week, we considered education and the economics of mutuality. You can watch the session recording on our website, purposeintopractice.org. The topic of today's webinar is corporate purpose as a new investment model. It will last for 1 hour, including a Q&A section at the end. Please submit your questions through the Zoom Q&A function at any point during the session. We will be focusing on chapters 17 and 19, which you can read online for free at purposeintopractice.org. In next week's webinar, we will be discussing the importance of purposeful leadership with the former CEO of Best Buy, Hubert Joly, and the former CEO of Engie, Isabelle Cocher. Please take a moment to invite your network to join. You can do this with ease through the LinkedIn event by clicking the Invite Connections button. I'll now hand over to the book's co-editor, who will introduce you to today's speakers. Colin Mayer, CBE, is Peter Moore's Professor of Management Studies at Saïd Business School. Thank you.
Hello and welcome to today's webinar. In the previous sessions, we've looked at the agenda of putting purpose at the heart of business, at how in practice companies are doing this through adopting meaningful challenges and solving the problems of people and planet. We've looked at the measurement of purpose and how standardizations of metrics are emerging and the implications of that for the adoption of purpose in business. We've looked at the power of investors to affect change and the role that they can and should play in promoting purpose in business. And last week we looked at education and the importance of business schools in educating current and next generation of business leaders. Today we turn to corporate purpose as a business investment model, an innovation that offers the opportunities of creating a new investment class which yields both higher value and lower risk from solving some of the world's most significant challenges and problems. And to introduce today's speaker, I'll now hand over to Nadia Terthus, who is the Managing Director of the Economics Mutuality Solution.
Thank you very much, Colin, and welcome to all. We have today the pleasure to have Paul Jarrah and Gavin Long with us to share this perspective on the topic of the day, purpose as a new investment model. As Colin mentioned, investors are a major, if not the most important stakeholder for the world to accelerate the uptake of a more complete form of capitalism that performs better than the purely financial version, but also is fair to all stakeholders. You will see that both speakers believe it is important to explore a new purpose-driven approach for the investment cycle that goes beyond ESG, and I will explain why. That new approach would offer a robust methodology to connect the levers of purposeful performance and economic and financial performance with reporting. And that thinking is very much in line with the recent paper, Measuring Purpose and Integrated Framework, which was published by Colin Mayer and Bruno Roche, among other renowned co-authors. So let me now introduce both speakers. So Paul Jarrah is the MP of Thompson Family Office. He has 20 years of direct experience in investment banking and asset management with Harvard Management Company, Credit Suisse, ING, Barings, Thompson Family Office, as I mentioned. He also has 10 years of earlier experience in external and internal auditing and operational risk management at EY and ING. Gavin Long is the co-founder and partner of the Acacia Group, a PE investor that aims at transforming industries and promoting the common good. Gavin acted as CEO for 2 of the portfolio companies, considering asset transformation as a key lever of performance. He has 15 years of experience in corporate finance and transactions, working with Imperial Capital and Arthur Andersen, among others. And he also has very strong experience in providing tech solutions, e.g. digital transformation, advanced analytics, to government and business clients. Let me start asking my first question to Paul. So Paul, the assets that integrate some sort of sustainable investing comprise about 30% of all US assets under professional management today. And it's about the same ratio worldwide. So the question is, what is actually the reality of that responsible investing? Do you see any difference across investment classes or by type of investors or by geography? And to what extent can we say that responsible investing brings to investors both financial returns and societal impact as it should be expected?
Thanks, Nadia, for allowing me to speak today. It's a very interesting topic and close to my heart. Let's go down a little bit of a journey down memory lane. Around 28 years ago, I worked at Harvard Management Company, the endowment, and we were one of the first players in the industry to have a negative screen on investing in South Africa. And at that time, I recall Wall Street and a lot of the Harvard alumni and the investment community thought it was social activism to take that kind of move to use the value and the influence of Harvard's endowment to influence behaviors in both social, human, economic terms, okay? We've come a long way since then. And over the last 15 years, particularly, you see this movement towards ESG. And for those who don't know what that is, environmental, social, and governance, just to outline that, that means a lot of things to a lot of different people. And it's being used in many different ways. There's also a term that's common out there called impact investing, where they're approaching the family office with a view to invest in areas that share their values, but and with a view that perhaps give less of a return for the benefit that's derived from their purpose and their values. But what's more importantly about all this is the fact that the major investment organizations around the world are moving rapidly into this area. And in such, they're having a lot of influence on these measures of ESG. The first phase was very much focused a lot on the E because it's measurable. And most things in life, people want to do, and when they're making claims on ESG, they want to be able to substantiate the claims that they're making. And when you're dealing with environmental things like social, like wind, solar power, and other renewable energies, those are very measurable in terms of carbon footprint. You hear folks like BlackRock recently talk about net zero carbon movements. What does that really mean? How is it really measured? And it's going to be an interesting period as we move into phase 2 beyond ESG, where the regulators are now looking to ESG and the claims these organizations are making, that what the claims they're making towards their investors are indeed achieved. But the problem in many cases is the measurements and the definition of ESG is really being defined by a whole host of groups, even those who might even be conflicted in defining ESG and measuring their own metrics against those areas. So what always impressed me about what I call ESG 2.0 or beyond ESG with economics of mutuality, it's going back to the basics, looking at social, human, natural, and capitalism drivers. So the real achievement is eventually going to come with the further definition of linking mutual profitability or mutual return connected to financial return. Because we're all aware that many people out there are focused on trying to achieve an asset class or achieve an investment approach that meet the investor's needs. But at the end of the day, there's a lot of greenwashing, as they say, where there's grandiose statements about achieving certain environmental, human, social changes in an organization, but they're not necessarily defined in, detailed about how those factors are going to be measured, where the philosophy of around EOM and putting purpose into practice is really going to be driven towards finding profitable solutions to people and planet to meet those objectives of those investors in a defined way. And on your other question, more broadly, globally, The Europeans, particularly the Northern Europeans, were very early movers in this area. I had worked at ING. We are very active. The pension plans in the Netherlands, AP, PGGM, ABP were early adopters. And that introduces also a challenge for many of these asset managers because they have a fiduciary responsibility for the pension plans to achieve returns, to meet those pension liabilities, but that has to be balanced, okay? Balanced in a way where they can achieve both. And when you get back to basics and really start driving these defined ways of social, human, and natural and financial capitalism with a view of financial capitalism isn't putting profits before people and planet. If it's done in the appropriate way, I would argue you can even enhance return and achieve greater value creation that's sustainable and enduring than some of the other approach. But we're in the early days of real ESG. I would even go beyond that term ESG into mutual stakeholder alignment to value creation.
Thank you very much, Paul. So ESG has indeed become big in the investment space, but it's also flawed. I mean, in terms of, there's a lot of greenwashing, as you mentioned, and you also mentioned the fact that recently there are more, reactions from the regulators, e.g. The SEC, which flagged some portfolio management practices that were not even consistent with the stated ESG approach. And then there is a huge variation in terms of how you measure ESG. And finally, the question of the holistic value creation is not completely clear. Gavin, well, based on that diagnostic, can you elaborate on your aspiration to develop a purpose-driven approach in the investment space, both in terms of post-investment operational methodology, but also in terms of investment philosophy when the capital is being called?
Yes, so thank you, Nadia. Thank you, Bruno and team for having me. It's a pleasure to be here and pleasure being here with you, Paul. From a investment management point of view, Nadia, having been in the investment banking space for 20 years and then moving into private equity, there are certain patterns that private equity has embraced, which largely is a greater and greater aggregation of assets under management. And that's, I'd argue, had some implications that could potentially be negative, because at the end of the day, it's about the aggregation of more assets, and then there's a way in which deals are originated and looked at that potentially could have some just expedient deal decision making. So in other words, there may not be a lot of knowledge around that industry. You're kind of getting smart quickly on that area, and then ultimately deploying capital. And so from a deployment of capital, from an origination point of view, from an evaluation of an opportunity point of view, and from an operational point of view, there's almost very little purpose driver in any of it. And what we've tried to do by the use of economics and mutuality is flip that on its head and actually begin with purpose as a defining statement of not only the investment initiative, but the LPs to whom we call that capital. Then the way in which we have leveraged economics and mutuality is, as we define an industry that we're in and we define those pain points and those problems, then that allows us to determine a purpose statement. And then literally we are raising capital around those purposes. What that's really provided us with an opportunity to do is then, as we look at M&A targets within an ecosystem, we actually use the ecosystem mapping of economics and mutuality to determine where those potential pain points could be identified. And what you're already hearing is economics and mutuality is actually creating in value in the investment cycle, because now you've got potential M&A targets that have the ecosystem around them. And we've actually, in tandem with economics and mutuality solutions, begin to identify those key metrics that we can begin to benchmark companies and their performance and go eyes wide open to how companies are actually performing within their ecosystem. Why is that important? Well, that's actually already identifying what I would argue are leading indicators to potential financial performance problems or financial performance opportunities. So actually in the defining of the fund's investment purpose, the calling of the capital, the looking at the market opportunity and running those metrics, we're actually using EOM to create value in the investment process. When those leading indicators that are non-financial metrics are identified, from an operational point of view, that allows you to go in eyes wide open to the investment and literally create value for LPs. We think that is a profound sea change to, at least currently, how private equity is normally functioning. I make an argument, not to sound overly critical, but it's become a large asset class. It's become largely operationally disengaged. That can provide some really poor behavior patterns from private equity that largely are predicated on financial engineering and financial engineering alone. And therefore, financial performance and these non-financial oversight mechanisms are largely divorced. By reintegrating these four forms of capital, human, social, natural, and financial, we believe we're able to articulate a completely new value proposition, not only to LPs, but to Paul's mention about ESG. This is no longer searching for a series of metrics that one can use to kind of, ostensibly put oneself in a $1 trillion investment category just for the expedience of raising the capital. You can legitimately have a methodology, an operational implementation. And one of the things I love about EOM, about economics and mutuality, is it defines itself as a management innovation. So this is not a series of, artificially, constructed metrics that you just lay over the top. It's an operational methodology that a CEO can ultimately employ, disseminate within the organization, and have repeatable processes that actually render financial returns. And there's now a direct correlation that one can establish within that.
Gavin, just a follow-up on that. That would allow an alignment across all the stakeholders in the investment space. So the GP, the LPs, the LPs, the GPs, the senior executives, and the employees, right?
Yes. So a big deal for us is how do you call that capital, and that the LP capital has to be aligned with the operational activities and the investment activities of the general partnership. And the general partnership has to be able to communicate that to the senior executives, CEO, CFO, COO, in a cohesive way. And that's ultimately that putting of purpose into practice has to be able to be implemented within the fuller organization. That is an aligned stakeholder ecosystem of which purpose and the way purpose is ultimately implemented can go up and down that stack. I'll give you a little anecdote. I have a dear friend who is a CEO of a large publicly traded company. And he said, listen, at the end of the day, I do what my investors tell me to do. He said, my investors are going to beat up on me one way or the other, and I'm going to do whatever I can do to reduce that pain. And he said, so if my investors and I are aligned, then it allows me to respond to them and their mandate. But unless, in essence, the LP's capital is called on a basis that's driven by purpose, and the GPs are committed to ultimately investing on that basis and then managing the senior level leadership and reporting, unless that sequence is in line, I think it's going to be hard to actually achieve real substantial results that are true and honest and truly connected to financial performance. Because without that alignment, I think there's a system of greenwashing that will almost inherently happen.
Thank you very much, Gavin, because you really described how basically purpose can really drive investment throughout the cycle, from the moment we originate to the deployment to actually the operational transformation. With what you said, the non-financial indicators as being actually leading indicators for financial performance in this operational transformation.
Just to put a little punctuation on that, Nadia, I think that's maybe one of the most compelling elements about economics and mutuality and putting purpose into practice, is that often people ask the questions around ESG and around things that are socially or human capital driven or environmentally driven. Is this just in essence philanthropy? Are we trading off? There are even been discussions of, can we even implement this because we're not being good fiduciary managers and responsible from a fiduciary point of view. EOM basically completely annihilates that argument, because now you're actually taking those non-financial metrics and you're using them as a leading indicator. Financial reporting actually by definition is a lagging indicator. So wouldn't investors and wouldn't operators want to have those leading indicators to suggest that we know where the potential weaknesses are from a financial performance? And I think that's where paradigmatically, this is a massive change in the way capital is deployed.
Thank you, Gavin. Paul, we've talked about the investors, but now obviously the financial community is much broader, I would say. So how about beyond the investors, where does this financial community stand? If I look at the equity analysts, the banks, the rating agencies, how do we make sure that actually everyone can onboard on a purpose-driven investment model?
Thanks, Nadia. That's a very good point. You see not only on the investment side, but on the sell side, analysts are now reviewing companies to understand their ESG or the sustainable investment policy. Again, that's on the banking side, you see a lot of the advent of the green bonds and preferred lending for those who are following certain ESG metrics. But this is all coming back to a common matter, and that is, what efforts are in place to find that common measurement and reporting methodology? Consistency is important here, because there's really presently no gatekeeper on this. How one defines ESG or what economics and mutuality and what are the trade-offs are going to be more and more important. It was almost unheard of 5 years ago when I worked with a group in ING and private equity to be asked by the investor, what is your ESG policy? And the standard response was, well, we look at everything through an ESG lens, but what does that really mean? Okay. And then you got the other more operational focused private equity groups who are really driving at maybe one aspect of whether it's the environment, natural capital, social capital for empowerment of women or diversification, to financial capitalism when you get into financial engineering, because we've all very aware where if these types of capital aren't aligned across what I call both the left and right side of the balance sheet, you can have problems. I lived through the experience of a bank, a well-known bank in London going bust because of a rogue trader. Okay, that's where certain disciplines were not put in place over the need to follow profit. When we got into the financial crisis in 2008, that was another example where financial capitalism was gained at the cost of people and planet, because there were people who truly suffered from the actions of those financial disasters. When I was in London at Barings, when that collapse happened, there were charities, and it was heartbreaking to see them lose the value of their bonds and their value of their investments at the cost of a few people gaming a system at a time. So when you think about these various forms of capitalism, there's got to be guardrails, okay? And those guardrails are not fully defined yet. They're going to be, we're in the second inning of this, I believe, and it's going to be more powerful. So it's going to make sure the whole system works more effectively, where capital is allocated from the lending side to those who walk the talk and are not greenwashing, and equally on the other side, firms like Gavin's and technology are powerful because they're going to be influence a lot of social capitalism in terms of how information shared, because there's not a scarcity of capital anymore. It's really a scarcity of effective allocation of resources. okay? And there's power in groups and relationships. We see that in social media, how people think about how their money is allocated. And we are really moving into a very interesting time with these Gen Zs and millennials. You're going to have one of the largest wealth transfers from the baby boomers into this next generation. And they're thinking very differently about how they report information, how their investments are getting a type of return. And they will require measurements beyond just financial returns, which they clearly want and should get, but they'll also want to see the impact of that financial return on people and planet. So going back to what Mars had set out a while, finding profitable solutions to people and planet, not finding profitable ways to destroy people and planet. So that's the paradigm that this methodology is putting on its head. And I think it's going to be very exciting in the years to come.
And Paul, you were mentioning the guardrails. I guess there's also a question of the right incentives, right? Creating the right incentives for this community for the financial community as a whole. Gavin, I have a question around, do you think, because obviously there's a lot of, I would say, demonstration that still needs to happen. So PE there's a big advantage of PE is that somehow you're not submitted to market pressure, and you have also a relatively long-term time horizon to actually, prove something. So the question I have is, do you think PE could lead the way and practically demonstrate that it is possible to deliver long-lasting, holistic value for the investors, for the portfolio companies, for society and the planet?
So I feel a bit biased when I say this, but I absolutely not only believe that private equity could, I not only believe that private equity should, I actually believe that private equity is the necessary leader in this transformation. And the reason I believe that is you've already touched on a couple of elements. Number one, measuring quarter by quarter in the publicly traded environment is extraordinarily difficult. And really, I think there will be, and I may be behind in this, to be just intellectually honest for a second, but I think there is an arc of education around equity analysts thinking about value creation with respect to this lens. As such, what I mentioned before in the previous conversation was the way in which capital called, the LPs that are participating in a fund and their vision for how economics of mutuality can be implemented to maximize shareholder returns, I think it is going to require a bit of a longer arc. And so there are two elements that that I would say private equity affords. Number one is that long arc and measuring on MOIC, which is money on invested capital. So a lot of our LPs, both institutional and family offices, because there is, to Paul's point, a surplus of financial capital, and there's a dearth of really quality investment opportunities, our LPs would much rather see a longer arc, a higher kind of return cash on cash, as opposed to just turning over assets quickly. There is always reallocation risk within the private equity portfolio. And as such, having a longer term arc and creating longer term value is something that private equity can and really should do. On that note, it allows this operational methodology, this management innovation, to really become deeply inculcated within the organization to produce those superior returns. And so I think private equity has a unique advantage in that respect. Number two, private equity, particularly I would say on the buyout side, even beyond venture and beyond growth, equity has a unique advantage because candidly, it's a control investor. And again, I believe that the GPs and the general partners and the way that they connect with the limited partners and ultimately how they implement within a management oversight, the way they report, even at a board level on a quarterly basis for the assets within the portfolio, that can be mandated, overseen. I don't like to, we're very collaborative with our portfolio companies. So I don't like to use the word like that we're imposing or we're dictating, but we do set the standards, not only of financial performance, but non-financial metrics and reporting. So if we can do that, then it seems that private equity represents an important catalyst that actually can align these different players in the ecosystem and actually have that longer term view, that kind of authoritative leadership approach that can truly seek to implement economics and mutuality in a highly integrated and highly, it has integrity to it, to the process.
Thank you very much. Maybe a question for Bruno, because I see that there are some questions around, how does that, if we have a very concrete example of a holistic, value creation through a case study, Bruno, you may want to give, an example of how EOM typically was implemented in one case.
Yeah, well, thank you, Nadia. And again, Gavin and Paul, thank you very much for this very insightful comment. And actually, I particularly love the idea that you framed that it's about moving from the simple metrics to a framework for management practices. And I can give you an example of one of the subsidiaries of Mars, which actually is completely rethinking the way they see value creation. And it's Mars is a consumer goods company, so essentially the growth of the business was made through innovation and marketing investment, primarily advertising and consumer promotion, which actually was a way to build brands. And brands eventually have become over the years not only a driver for value creation, but also the repository for the value created. And that's why we talked about intangible value that we find in the balance sheet. And essentially what we're discovering is that essentially there is another way of, in a sense, building brands and building this kind of intangible asset that eventually drive value creation, but also become the repository for the value created. And it is, surprisingly, not only just advertising, innovation, and consumer promotion, but it's also investment, targeted investment in the social and human capital in the ecosystem in which the firm operates. And it has to do with the level of trust, a level of knowledge, a level of social cohesion that exists among the key stakeholders that are actually the prescriptors of the company. It could be veterinarians, it could be, in the case of pet food, it could be veterinarians, it could be pet shops, it could be actually knowledge companies that actually gather data among for the health of pets and also the attitude of pet owners. So there is a whole ecosystem which actually is a reservoir of value creation that actually is often neglected. So there is a lot, if you like, of untapped capital that exists in the ecosystem in which most businesses operate, that they eventually could be measured, monitored, and mobilized and managed in such a way that it has an impact on society in terms of social human capital. It has an impact also on the environment, the form of natural capital, but also is connected directly to the performance of the business. So it's a very concrete example, actually, that a firm is in the process of transforming itself around the purpose, and the purpose is, in this case, a problem that exists in the ecosystem. In this case, it's the health for all cats and dogs. So it becomes actually a real business purpose, and the whole business actually is getting organized around that purpose with mobilization of resources that in the past were either neglected or mismanaged. So there is a great opportunity here through this framework of management practices and metrics to tap into untapped resources that eventually are being connected and invested back into the business. And actually, you shouldn't be surprised that when you're adding resources to a business, you end up with a higher level of performance. That's natural. We do this when we invest financial capital into the system, right? So we expect a higher level of performance. We should not be surprised that when we create social and human natural capital and we connect it to the core performance of business, that eventually the impact is superior also in terms of financial value creation. So that's a very concrete example that we are actually living at the moment. I hope I answered your question, Nadia.
Thank you, Bruno, for this very concrete example. Maybe if we get back to the investment space, Colin, I have a question for you. There is more and more scrutiny, and I mentioned a bit earlier the SEC vis-à-vis investment practices by regulators. So shall we expect an evolution of regulation, e.g. in the US or in Europe in that space?
Well, the short answer is yes. And actually, I'm going to have a go at answering your question in the context of two very good questions that have come in from Cora Strandberg around whether purpose is a way of essentially investors, or we should think about what's happening as investors are moving in the direction of financing the purpose of a business, and that we should expect there to be not just a say on pay or a say on climate, but a say on purpose going forward. Because I think we're going to observe those really as part of some of the regulatory developments that are going to go on. So to pick up on your question to begin with, Nadia, we are indeed observing significant shifts. For example, it wasn't that long ago that the view was expressed that according to ERISA rules, pension funds in the US really had to stick to their knitting and deliver financial returns to their beneficiaries. There's now a move that's suggesting that actually what we might be doing is to think about how pension funds are going to be a major player in terms of bringing about the changes in investment that we're talking about here. In this country, in the UK, we've had the emergence of a stewardship code, which is setting out the notion that institutional investors should, as part of their objectives, ensure that they engage with companies in such a way that they help companies to promote their purposes, so that there is a significant move in a direction of trying to join up the developments that have happened in relation to the corporate governance codes, which require companies in the UK now to expect their directors to determine their purpose and demonstrate how their purposes are aligned with their values, their culture, and their strategies. So exactly what Paul and Gavin were talking about in terms of trying to line up the various components from the asset owners through the asset managers, through the PE firms, possibly through to the boards of companies. That's exactly what we see going on. So then to relate it to Cora's question about whether or not what's going to happen is essentially that we're looking to investors to finance the purpose of the firm. That is exactly the direction in which things are and should be moving. And a say on purpose is indeed something that many of us feel would be a good addition to the forms of engagement that we see going on between investors and firms. But let me just put this in the context of where we're starting from, which is currently the extent to which this sort of engagement is going on is a lot less than it should be. We've been involved in interviewing the boards of some 60 or so companies in North America and in Europe, and more than 30 institutional investors. And there's quite a disjoint at the moment between the way in which boards of companies are looking to embed purpose in their businesses and the extent to which they reckon that they're getting the right level of interest from in the investor community. They don't feel that the investor community is really asking the pertinent questions about the adoption of purpose in their businesses. At the same time, the institutional investors are saying that they don't think that the boards of companies are really serious about pursuing purpose, and they certainly aren't providing the measures against which the investors can evaluate whether or not they're doing it. So all of these developments that we're talking about here are coming against a starting point at which, although the moves are in the right direction, there is a significant gap in understanding about the notion of purpose between what boards want to do and what investors see them as doing.
Thank you. Thank you, Colin. There's a question also around the time frame, because if we want to escape the quarter-to-quarter logic, the question is, what is the right time frame to actually check that a company has delivered on both, I would say, societal and financial value? When should we check that? And I don't know who, Paul or Gavin, or wants to take that question.
I have a thought on that. You heard me mention in the private equity context, we have a little longer evaluation period. Unfortunately, I think in the public equities environment, it may be very difficult to suggest that there's any other new time frame other than the quarter by quarter, but there's a silver lining. And I think the silver lining is that maybe what we're reporting on a quarter by quarter basis needs to change, as opposed to the quarter by basis cadence. What I mean by that is, I'll just say that this is a project that we've partnered with the Economics of Mutuality Solutions Group to look at a particular industry sector. We took 14 companies in that sector and we benchmarked them by EOM metrics alongside of each other. And we took human and social capital leading indicator metrics. Here's an interesting output of it. We know one of those companies that's going public. And in looking at that company that's going public, we can see by way of the evaluation that there's some weaker performance in areas of human and social capital. Now, if I were an investment banker or if I were an equity analyst, and I started to say, oh, well, listen, maybe we should measure to those things and we should make sure that those things are addressed and solved over the course of time. If your management were saying, this is the way that we're benchmarking in these non-financial performance areas, and we believe it's going to produce outsized financial return in the longer term, maybe it's not the cadence. Maybe it's a new body of reporting metrics that allow those non-financial metrics for the equity analysts and the investors to see that there's a longer term arc of transformation of the business. I give an example this way. I'm a technology investor, and we see technology investment of massive proportions. Equity analysts are more than willing, and investors are more than willing to back companies that are not near-term profitable because they believe in the longer-term story. What if we could take some of these non-financial performance metrics, adequately share that story with the equity analyst, tell a transformative arc of that company, demonstrate how it's going to outperform financially, and then actually use that quarter-to-quarter rhythm to basically take our eyes to a new body of performance metrics. That's what I think is probably more realistic, because I just don't know if the public equities markets is ever going to relax on the quarter by quarter. Paul's much more informed and knowledgeable than I am, so I'll defer to him. But that's my first statement.
Yeah, Nadia, I think, like I was referring to before, I think this next generation is going to be more forgiving, and it's not the outputs. It's starting to focus on the inputs. If they see real structural plans to start addressing natural capitalism, the environment, social factors, human capital, education, diversification, all these things that we're hearing around society. If they see these corporations really digging in deep in that, you're going to get I'll call it the ESG 2.0 halo effect over time. That's kind of my indication. It's very clear that a lot of these corporate social responsibility initiatives that are what I call whitewashing, a little bit greenwashing for annual statements, annual reporting, isn't going to fly over time. And people are going to see right through that, and they're going to be very cynical. And it could work negatively on that factor. There's also the issue around globalization going on here. I'm at a location today earlier with some groups from Latin America, and their family offices, and they're in Latin America, family offices are really drive a lot of those countries in terms of the businesses, and they operate in those countries. And for them to get capital out of the US with a lot of these new ESG focused investment firms, they have to apply by their definition of ESG and not the definition appropriate for the countries in which they're operating on, which is having a reverse effect of ESG, because they're viewing ESG as a political movement more than a fundamental movement to create value to them, to improve society in their countries in which they operate. And the way you operate in Latin America may be a little bit different than the way you operate in Northern Europe. So I think this global definition and the movement of having the right flexibility and metrics will be impactful. I would also argue that more recently, if you look at the stock market, a lot of these ESG related companies are doing extremely well because people like Elon Musk and others, they see what's going the next generation of companies are going to look like. Not just because they're promoting a social cause for the environment, is they know that the car industry is going to radically change with the advent of electric batteries, and the related companies related to lithium and these other areas will drive value longer term. So those kinds of companies will get the benefit of, if they have a clear strategy and plan to move to the new economy around impact, or EOM in this case, will be more relevant.
Thanks, Paul. Bruno, you want to add something?
Yeah, maybe I'd like to add something along the lines of actually how you can, in a sense, cross this valley of transformation. And of course, to do this, you need a philosophy, you need also a methodology, but you also need investors. And actually, investors are driven by, of course, a sense of return, right? But I like to make an analogy, because I used to work for a consumer goods company, and I remember there was a similar transformation that took place in the late 70s, early 80s, when eventually at the time, to be in business, to be a successful business, you just need to know how to produce and how to sell. If you knew how to produce and how to sell, you were in business, right? Then there was this concept of branding and marketing that actually started to become some sort of a reality in business. And there was a big debate at the time. And I did a bit of research myself. And the debate was, why do we need to bring people from the media industry, from the art, from the Hollywood industry? They are not business people, really, right? And there was a big debate whether why should we spend as much money, up to like 10% of the revenue of the company, to build something called brand. And there was a big debate. And the debate eventually, the successful company decided to invest in this kind of intangible asset called brand. And the company that did this not only were successful in terms of value creation, but also the brand, as I said before, has become a repository of value creation. Because today, if you wanted to buy a company like P&G or like Unilever, you wouldn't buy their manufacturing unit, you wouldn't buy their sales force, you would buy their brand. But I think we are at a very similar point in time in the history of business, that companies that do not make this kind of strategic shift, that it is investing in the ecosystem into which they operate, in interventions, social capital, human capital, natural capital intervention, in a sense to grow and enrich the ecosystem in which they operate, but in such a way that they would benefit to the business. The companies that will do this are the companies that actually will continue to thrive and prosper. The companies that will not embrace this kind of transformation are the companies that refused to invest in marketing 20, 30 years ago, and eventually they lost their edge and they've been acquired by the other companies. So I think we are not talking here of a topic which is just nice to have, or something that actually is, like to feel more responsible. Our argument is that it is an essential strategic move to ensure that companies continue to create value. But of course, to create this kind of value, it requires different muscles, different capabilities, different management processes, different management metrics and also different reporting metrics. And I think we are going to witness over the next decade this transformation. My hope is actually it will happen through knowledge, education, experiments, and not through a radical shift, but it is an evolution that is inevitable, and companies that embrace this kind of evolution will stay in business. The companies that do not embrace this kind of transformation will not in business, and it is up to the investors actually to understand the new rule of the game in order to maintain the value creation.
Thank you, Bruno. Gavin, you want to react maybe?
Yes, I love what Bruno just laid out, because I feel like I'm living that phenomenon. I think Bruno's actually heard me argue, if we don't implement this, that ultimately we will become a dinosaur. That's what I fundamentally believe. So that's the negative side of it. But there's another question in the Q&A. It was actually the first question from Bill, and I hope I'm pronouncing your last name right, Dukler. And if not, I apologize. But he asked about a practical example. I want to take the negative side of what Bruno said, with which I agree, and also turn that into a positive. So in our portfolio, we've run management consulting initiatives and analytics across the companies that we've invested in, leveraging economics of mutuality. As Paul mentioned earlier, there's no scarcity of financial capital, but there is a scarcity of human and social capital. And as the whole premise of completing capitalism has articulated, that's inverted over the last 50 years, where we had a dearth of financial capital, probably a surplus of human and social capital. That's inverted. We've seen an erosion of natural capital. That is a phenomenon that's happened. So by leveraging economics and mutuality practically within our portfolio, we were able to identify some pain points within our human capital and social capital management within one asset in particular. In doing so and rolling out a more cohesive strategy of how to measure and plan around human capital and social capital development, we created, and my industry that we invest in is in technology. And if there's any area that is decidedly under-resourced with respect to human and social capital, it's probably technology. It is very difficult to get a hold of talent. In rolling out some of our economics mutuality interventions, we created a much more sustainable, much more consistent employee base that was more fulfilled. We watched attrition go down. The direct correlation of that was ultimately that we saw a reduction in attrition and an increase in customer satisfaction. In fact, that asset ultimately ended up leading the customer satisfaction category across against some of the largest global systems integrators where we compete. And ultimately, that's translating in an outsized shareholder return, ultimately in an exit context. So when you think about that whole sequence, you can actually chart of how running an economics and mutuality endeavor, intervening in those human social capital endeavors actually creates shareholder value over the course of an investment thesis. And I think that's important to note, that it's directly moving toward creating that shareholder value.
Thanks, Gavin. There's also a question maybe more for Paul on the banks. So it says that in Canada, the 5 major banks have actually adopted a social purpose in the past few years. So they are starting to put purpose oversight into their board and committee charters. So the question is a little bit also, to what extent can we expect an acceleration of that purpose-driven approach in the banking sector?
Yeah, thanks, Nadia. That's what kind of I was alluding to previously about creating those common standards, right? We've seen similar evolution in banks. When I worked in the past in the area of derivatives, when credit default swaps came, or interest rate swaps in the 80s, these were off-balance sheet instruments. The banks didn't know how to report on them. And they finally worked within the banking community to start defining what are the risk measures on these and how do you report off balance sheet items. I think the similar approach will eventually happen within the banking industry. There'll be a commonality around this. There's this group called even Europe and the US, what's it called? The Sustainability Accounting Standards Board, right? Those are going to be more the independent groups that are going to start measuring these things. And it's happening in all kinds of business areas beyond just banking. I'm already seeing it in even fund administration now. A lot of these big asset management firms have these trillion-dollar fund administrators who are now advising these companies on their ESG, quote, EOM methodologies. These organizations have to get in front of their annual meetings and they're being asked the questions, what are you doing for social, human, natural, and environment? And they never really thought about it deeply and profoundly at the level of detail. So again, I think we're in those early innings of where we're going here. And the momentum has swung enough that the next generation of investors, maybe not the old guard, are really leaning into this. And they're going to want real clarity. And the technology is there, as Gavin said, around the world to measure this and report on it real time. You're already even seeing, look what's happening around us today with the evolution of digitalized assets and cryptocurrency and non-fungible tokens. This is ways that people are creating their own ecosystems of investment because they don't even trust maybe governments and cross-border in relative banking, cross-border payment systems anymore because they don't want to feel like they're being spied on. So I think there's a lot of interesting dynamics happening here in this time in history. And the old way of banking is going to be very much challenged. And we see that with challenger bank, fintech banks who can operate virtually at a fraction of the cost of traditional banks. Lending and crowdfunding is going to become more powerful with the tokenization of assets, and exchanges are now popping up around the world that allows that trading of capital on a more democratized way. So you can bring middle class, lower class income level folks into the real investment game on microfinancing or on taking a stake in a company based on a security token as a piece. So that's more aligned to their values locally. So if I'm in Des Moines, Iowa, for example, and there's this need for developing a school in my community and they're going to raise money for a for-profit education organization in that town, I might tokenize that asset to invest in that initiative locally because it touches me personally and my values versus the traditional way of sending my money to New York and getting charged 2 and 20 and letting a third-party group manage my portfolio, invest in real estate. So I really think in the next 5 to 10 years, you're going to see an evolution of where, banking and investment management coming closer and more of a democratization of investing in a way where more folks at the whole spectrum of the capital stack can invest in opportunities.
Thanks. Yeah, given we have very little time left, there's one question I would like to ask each of you, which is a question from the Q&A. So in an ideal world, which big corporations or key global organizations, and I'm adding key investors or key banks, whatever, would you like to see join this purpose-driven approach? It's not an easy question.
Maybe I'll lead off, Nadia, and I apologize. Is that Helena that answered that, or that asked that question?
Yes, that's Elena who asked the question, yeah.
So I apologize in advance for my answer because I'm going to be horribly unclear. But I think there's a methodology and maybe not a particular answer that I'd like to give. Is one of the things that Economics of Mutuality Solutions Group has helped us think through is thinking through the industries themselves. And so what I believe is in defining kind of an industry segment and benchmarking activities there, you can see who is leading the way or who has the potential of leading the way. And so I think that provides a uniqueness of opportunity of looking at industry by industry, people that could potentially be bellwethers or be leaders within that particular segment, which, by the way, dovetails into another question around, since purpose is particular to a given company, do you lose the kind of the universality of metrics that ESG, though imperfectly, is trying to achieve? I actually think if you begin to benchmark on an industry by industry basis, you can at least have a baseline across an industry to be able to compare within that market segment. So which I think allows you to achieve, Elena, to your question, who could be or should be the market leaders, but also how you create some, at least a degree of universality whereby to benchmark, purpose-driven performance.
Paul, you want to be next?
To me, Nadia?
Yes.
Yeah. Thanks for that question, Helena. She's a friend of mine. What's important on this one too is I think you're going to find, and I'm finding, being part of a family office, a lot of the momentum is going to come bottom up on this one. I really believe a lot of family offices will align with this and put pressure on where they allocate their capital with investing in companies, both public and private, that share their values. Okay. And that'll be one area, I think. And I think that momentum will push the big corporations to start really being forced to look at this more thoroughly and bringing other groups. Now, Bruno can explain, but they've spun out of Mars formally now, and they're being approached by some corporations to implement or evaluate how to apply EOM into their practices. So this is early days for this group in their new role outside of Mars, still Mars big clients. And I'm aware that there will be big institutions looking at this more formally going forward, both in not just Europe and the US, but even in Singapore and Asia.
Colleen and Bruno?
My answer is very simple. I'd expect and look for every single large company to be doing this, because they're all going to benefit, frankly.
And maybe as a last word, I'd like to quote one of my favorite philosopher who happens to be German, actually. So it's a bit of a change. And it's Schopenhauer who said actually that every truth goes through 4 stages. The first one, that it is ignored. Second stage, that it is ridiculed. The third stage, that it is being violently opposed. And the fourth stage, it is accepted as self-evident. So I think we are here not telling the truth, but we are approaching the truth. And essentially, this element of truth that business is not about maximizing profits, but business is about developing profitable and scalable solutions to the problem of people and planet, is essentially a truth that will eventually impose itself, hopefully without too much time. But I can see actually a real momentum coming from the investment world. And I think it is really important because the investment world has become over the years the driving force for change in that sector. So I really want to thank you both for your insightful comments and also your vision. And I totally agreed actually that this journey from ignorance to enlightenment is a bit similar to the journey from astrology to astronomy. And as we are getting closer to the astronomy understanding of how business works, eventually a growing number of companies and investors will gather under this umbrella of purpose is about maximizing solutions for maximizing profitable solutions for the problem and people and planet, and not profiting from creating problems to people and planet.
Yeah, I'll just say thank you so much to Paul and Gavin for sharing their thoughts, and obviously to Bruno and Colleen as well for organizing also this series of webinars. And yeah, hope it was enlightening, and see you soon again. Thanks.
Thank you.
Thanks, everyone.